Welcome to the deep dive. If you need, a shortcut to being well informed about the complex world of commercial real estate, you have definitely come to the right place. Today, we are taking the express lane straight into Indianapolis, the crossroads of America.
And that nickname, it isn't just civic pride.
Yeah.
I mean, it really defines the local economy.
Right.
Indianapolis is a massive logistics and economic powerhouse, and we've gathered, an extensive stack of Q3 2025 reports and forecasts, all aimed at understanding the 2026 landscape.
So our mission today is really for you, the listener, to figure out where this market is heading, particularly as it navigates all that national turbulence, like those fluctuating interest rates we've all been watching so closely.
And what's fascinating here is that the theme across, every source we reviewed is one of decisive but cautious optimism. They're not predicting a retreat.
Right.
They're predicting strategic growth.
Okay, so let's unpack that resilience. Analysts are forecasting transaction volumes could rise by, a solid 15 to 20% next year.
They are. And that's primarily because they expect interest rates to finally stabilize.
Giving investors some clarity.
Exactly. Plus, U.S. GDP growth is anticipated to hold steady around 2.5%. So that foundation feels pretty solid.
It does, but you're saying the growth won't be uniform across the board.
No, not at all. The market is really defined by 6 pivotal trends, what we're calling the 6 pillars of Indy CRE in 2026.
Okay.
We have to look at the industrial sector's dominance, the office market's bifurcation, sustainability becoming essential, retail's resilience, these emerging neighborhoods, and the big one,
The property tax hikes.
the severe headwind of property tax hikes.
That is a powerful roadmap. So let's jump straight into the good news, the crown jewel, the industrial sector. For anyone investing here, this is the bedrock.
It is. Indianapolis leverages its central location, that robust transportation infrastructure.
The I-69 corridor expansions, upgrades at the airport.
It all feeds into that industrial stability.
Yeah.
And the data for Q3 2025 shows a market that's not just recovering, it's thriving.
Okay, so what's the core story there?
Tightening vacancy. And it's happening fast. We're looking at reports citing vacancy down to 9.0%.
And that's a big drop.
It's a 150 basis point drop, just quarter over quarter in one analysis.
Wow.
Another report has it a little higher at 9.3%, but they note that's the lowest rate they've tracked since Q3 of 2023.
So intense competition for space. And I saw one report that put overall vacancy a bit higher, maybe 10.3%. But this is the fascinating part.
Right.
Big box spaces, those massive distribution centers, over 500,000 square feet, they saw the steepest decline of all.
By how much?
Vacancy compressed by a massive 210 basis points.
Well, that's huge. The steepness of that compression, it confirms something crucial. Occupier confidence is incredibly high.
They're not signing short-term deals.
No, firms are committing long-term to these large modern facilities. They're betting heavily on Indianapolis as their logistical hub for the foreseeable future.
And we have the leasing activity to back that up. New leasing year-to-date is staggering.
The figures land somewhere between 9.6 million and 12.1 million square feet, depending on the source.
We're talking about new leasing activity, surging 45% year over year.
45% is an enormous signal of demand. But the flip side of this equation is just as important for the market's health.
The development pipeline.
Development hasn't gone crazy. The pipeline actually moderated by 37% year over year.
So developers are being disciplined, and that supply constraint is key.
It's absolutely key. It ensures the market doesn't get swamped just when demand is peaking.
And when demand soars and supply slows.
You get vacancy compression leading to rent growth. It's the magic formula. Experts anticipate rent growth resuming strongly in 2026, hitting that $6 to $7 per square foot range.
So if you're an investor looking for those high ROI submarkets, where should you be focusing?
The source is really consistent on this. You want to look at Avon, Whitestown, and specifically the area around Moore Logistics Park.
Okay, why Avon?
It's prime location, near major interchanges. It offers slightly better ingress and egress for high-volume shipping compared to some of the other submarkets.
And that brings us to a really valuable investment nugget we found. The sources advocate for syndication as a strategy here.
Yeah, an ideal strategy for diversifying in the logistics sector. And they give a fantastic benchmark.
Which is?
Avon warehouses are cited as consistently yielding 8 to 10% returns. That's a powerful target for potential partners.
That level of detail, the stability, it really defines the industrial space heading into 2026.
It's the easiest bet in town.
Okay, so If industrial is the engine, the office sector feels like a major point of friction right now. What's the main challenge there?
The challenge is office market bifurcation. And it's critical for investors to get this. The market is actively splitting in two.
Driven by hybrid and remote work models.
Exactly. This isn't just slow growth. It's a structural divide between high-quality Class A spaces and, well, everything else.
It's that flight to quality in action. Tenants downsize their footprint, but they up the quality of what they keep.
Precisely. And the numbers show it so clearly. Look downtown at the Central Business District.
High vacancy.
Elevated vacancy rates, hovering uncomfortably between 20 and 24%. It's a very difficult market for older, generic downtown buildings.
But the suburbs are telling a different story.
They're actively outperforming. Areas like the Meridian Corridor, Carmel, Fishers, they are winning the flight to quality battle. The Meridian Corridor, for instance, has a vacancy rate of 18.4%.
Which is noticeably lower.
Much lower. And the reports suggest occupiers are willing to pay a premium for spaces that facilitate modern collaboration, enhanced HVAC, natural light, high-end amenities.
Even with that suburban strength, though, the overall numbers are tough. I mean, vacancy has climbed from 16.3% in 2019 to almost 23% now.
It has. That's a lot of empty desks.
So how is the market supposed to mitigate this massive overhang of, outdated space?
Adaptive reuse is the primary solution. And it's finally gaining some real traction.
Office to multifamily conversions.
Exactly. It's essential to chip away at that vacancy. So for an investor, the opportunity is either buying the pristine Class A spaces or, maybe more strategically, looking at older properties primed for conversion.
And that sets up a really good contrast with the retail sector, which is sort of the quiet success story here.
It really is.
Yeah.
Despite the constant competition from e-commerce, retail seems to have found its footing. It's showing real resilience.
What's supporting that stability?
Two main factors in Indy. First, limited new supply. Developers learned their lesson a long time ago.
Right.
And second, a laser focus on experiential formats. Dining, entertainment, services. People still want to go out.
And you can see that confidence in the net absorption figure.
Absolutely. One report had the Q3 net absorption at a positive 240,000 square feet. That shows solid demand, especially for those mixed-use lifestyle centers.
So where's the smart money going for retail?
The sources suggest targeting mixed-use retail in those high-growth suburban areas, like Geist. There's stable locations that deliver steady yields.
What kind of yields are we talking?
We're seeing cap rates around 7% in those Geist hotspots. So reliable performance for investors focused more on cash flow than, say, massive appreciation.
Okay, this is a great place to shift focus to the driving forces shaping the market for 2026, starting with sustainability. It seems like it's moving from a nice-to-have to a necessity.
It is entirely a necessity now. The market is demanding sustainable and resilient building practices, driven by corporate mandates and, frankly, operational cost savings.
So we're seeing an emphasis on certifications like LEED and Energy Star.
A significant emphasis.
What's the measurable financial incentive for an investor to go green? What's the ROI?
The ROI is very clear. Certified green buildings command 5 to 10% higher values on average and have much better tenant retention.
And the operating costs?
Even more compelling. Green retrofits on older buildings can slash operating cost utilities, maintenance by 10 to 20%. For a large corporate tenant, this is non-negotiable.
And we have specific tenant types demanding this, don't we?
Yes, the sources specifically note that Indianapolis's growing biotech and life sciences cluster. They are actively seeking and prioritizing LED-compliant spaces.
So if you want to attract that high-value tenant,
sustainability is now table stakes.
And that ties perfectly into our next pillar, emerging neighborhoods and mixed-use growth. You see these big infrastructure investments from Indy DPW, you see the demographic growth.
And the commercial viability just naturally spills beyond the core. The growth is undeniable.
So which areas are booming?
The sources list a distinct group: Carmel, Fishers, Noblesville, Zionsville, and Westfield. Look at a project like McCord Square in Fishers.
Creating a whole new center of gravity.
Exactly. But it's not just the suburbs.
No, the urban revival projects are crucial. The Bottleworks District continues to be this huge success story, and we have major transformations planned for Circle Center Mall.
Absolutely. And don't forget Broad Ripple's master plan, with its focus on walkability and White River access. These urban spots are essential for keeping the core dynamic.
So for an investor, how do you play this geographical expansion?
Mixed-use syndication in these growing spots is identified as a robust strategy. It lets you diversify your returns across office, retail, and multifamily, all within one high-growth area. It hedges your bets.
Okay, now we get to the single biggest headwind, the unavoidable challenge facing every investor in the region for 2026.
Property taxes.
This is crucial information, and it could be a major shock for you, the listener.
It raises a big question. How do you forecast returns when your operational costs are about to jump this significantly?
What's the core issue?
It's the sharp increase in property assessments. Marion County saw an average hike of 27% in 2025 assessments.
And that assessment drives the tax bill that's due in 2026.
The significantly higher tax bill. And statewide, commercial values rose between 16 and 27%.
27%. I mean, that is a massive jump in operating costs. It can wipe out years of gains. Is there any mitigation in place?
Yes, there are structural reforms, but they're pretty technical.
Okay, let's break them down.
This comes from Series A1 legislation. There are two critical parts. First, it eliminates the 30% depreciation floor after 2025.
Okay, hold on. Eliminating the 30% depreciation floor, for the typical investor, what does that practically mean for their tax bill?
Well, that floor was a minimum value set for an older property, often regardless of its actual market value.
Got it.
Eliminating it means assessors must now look more closely at the true market value. So theoretically, older or distressed properties that are truly declining in value can be assessed lower than that old minimum.
So it helps those adaptive reuse projects we talked about.
It really does.
Okay, and the second part?
The second part is that supplemental deductions are set to rise to 40% in 2026.
And that's immediate relief.
That is immediate relief designed to reduce the net taxable value. A bigger deduction lowers the base amount your tax rate is applied to. It's a substantial move designed to ease the immediate pain of that assessment hike.
So the pain is real, but the state is providing tools for future relief. What is the single most crucial, actionable detail listeners need to write down right now?
It's the appeal deadline. Given these huge hikes, you cannot be passive. You have to proactively manage your property's valuation, and the deadline for filing appeals is June 15, 2026.
So engaging an expert to review your assessment.
It's probably the single best investment you can make this year.
That's powerful advice. Let's synthesize these 6 pillars into a final action plan for 2026.
Okay, 2026 in Indianapolis is defined by 1, industrial stability.
Yeah.
That sector is the dependable bedrock.
Right.
2, adaptability is required in the office sector. You have to own premium suburban quality or properties ripe for conversion. And 3, geographical expansion outside the core is a reality for growth.
And the practical takeaway from all that?
Investors have to proactively manage those increasing tax burdens using the new legislative tools. The sources all emphasize focusing on resilient sectors and
finding strategic partnerships.
exactly to get access to off-market deals, especially in logistics and high-performing suburban retail.
So if we connect all this, while that 27% tax hike is causing immediate shock, the legislative response, eliminating the depreciation floor, increasing the deductions, that seems really significant for the long-term health of the market.
It is. It's highly significant.
So here's a final thought for you to chew on. Despite the immediate shock of that 27% property tax assessment hike, how might the combination of those structural reforms fundamentally change long-term valuation calculations for commercial assets in Indianapolis beyond the immediate 2026 pain? We've seen the price of today's pain, but the long game, driven by that tax reform, might look quite different.